Have you ever wondered what stops a massive company from just, well, falling into total chaos? It's definitely not magic. It's this powerful and mostly invisible framework called internal controls. You can think of them as the unsung heroes working behind the scenes, making sure a business runs smoothly and that its financial reports are actually trustworthy.
So, here's our roadmap for today. First, we're going to dig into why these controls are so incredibly important. Then, we'll break down the 5 core components that make up their foundation. We'll also look at what happens when even good controls fail, peek inside an auditor's toolkit to see how they test these systems, and finally, cover how they report any weak links they find.
All right, let's jump into section 1. So, why do we even care about all this? Well, it's because literally everything, investor confidence, market stability, a company's entire reputation, is built on a foundation of financial trust.
I mean, seriously, think about it for a second. You've got thousands, maybe millions of transactions, hundreds of employees, constant pressure to perform. What is the one thing holding all of that together and stopping it from becoming a complete mess? Well, the answer is a well-designed, effective system of internal controls.
And that leads us to a huge concept for auditors. Control risk is pretty much what it sounds like. It's the risk that the company's safety net has a hole in it. A hole that's big enough for a major mistake or even fraud to slip right on through. So, the stronger the controls, the lower the control risk, and the better everyone, auditors and investors, can sleep at night. Okay, so if we're building this fortress to protect a company from risk, what does the blueprint actually look like? That brings us to part 2, the 5 core components of internal control. These are the absolute pillars holding the entire structure up.
And here they are. You can see the control environment as the foundation, and then you have risk assessment, the information system, control activities, and finally, monitoring. Now, the key thing here is how they're all connected. This isn't just some checklist you tick off. It's a living, breathing system where each part affects the others. Let's break them down one by one.
First up, the control environment. Honestly, this is the big one. It's the culture, the ethics. You could even say it's the soul of the company. It all starts with what we call the tone at the top. Does management actually practice what they preach when it comes to integrity? Are people held accountable for their actions? Because without a strong control environment, all the other rules and procedures are basically built on quicksand. Next up, a company can't just sit around and wait for something bad to happen. It's got to be proactive, and that's where risk assessment comes in. This is all about scanning the horizon for potential threats. Things like a brand new IT system, growing too fast, or sudden changes in accounting rules, and then figuring out how to deal with those risks before they blow up into real problems. The third component is the information system and communication. The best way to think about this is like the company's central nervous system. It's the entire web of procedures, both digital and on paper, that captures every single transaction, from a tiny sale to a massive expense, and makes sure that all that information flows accurately and completely into the financial reports. Okay, now we're getting to the really practical, on-the-ground stuff, control activities. These are the specific, everyday actions that make the policies real. Things like needing a manager's signature, doing a bank reconciliation every month, or just locking cash up in a safe. And a classic one, which is so important, is segregation of duties. The logic here is simple. You never, ever want the same person who authorizes a payment to also be the one who actually makes the payment. It's a fundamental check and balance. And last but not least, we have monitoring. See, a control system isn't something you can just set up and then forget about. It needs to be constantly watched, evaluated, and improved. It's this continuous cycle of checking to see what works, identifying weaknesses, and then fixing them. This is often where a company's internal audit team really earns their paycheck.
But, and this is a really crucial reality check, no system is ever going to be perfect. So for our third section, let's look at what happens when good controls go bad by digging into the inherent limitations of any system.
So, why aren't they perfect? Well, a few big reasons. First, you've always got the chance of simple human error. People just make mistakes. Sometimes the control itself was just a bad idea or poorly designed. Then you get into the more deliberate stuff, like collusion, where a couple of people team up to cheat the system. And maybe the most dangerous one? Management override. That's when leaders just decide the rules don't apply to them. And finally, sometimes it's just a judgment call. Management might decide a certain control is simply too expensive to be worth it.
This slide is great because it makes all those abstract ideas totally real. Human error? That's just a warehouse worker miscounting some boxes. Collusion? That's a payroll clerk and their boss cooking up some fake overtime. Management override? That's a director straight up falsifying records to hit a profit target.
And my personal favorite here is the ineffective control. A manager who just signs off on mileage claims without even looking at them. The signature is there, so on paper the control exists, but in reality, it's completely useless.
So, knowing that all these things can go wrong, how do auditors figure out what's really going on inside a company? For Section 4, let's pop open the auditor's toolkit and look at the actual methods they use to document and test these systems.
A huge tool for them is the questionnaires, and there are basically two main flavors. You've got the ICQ, which is a straightforward yes or no checklist. Does a supervisor sign this? Simple. Then you have the ICQ, which is more open-ended. It asks, how does the company make sure this happens? The first one is fast for confirming a control exists, but that second one is how you truly understand the process and find where it might be weak.
So once they gather all this information, auditors have to document it. And as you can see, every method has its pros and cons. Narrative notes are easy, but they can get messy real quick. Flowcharts are awesome for seeing the big picture, but they're a pain to change. And questionnaires are quick, but they can be a bit superficial. And that is exactly why, in the real world, auditors almost always use a mix of all three to get the full story.
But, just understanding the system is only half the job. Auditors have to actually test that it works. It's kind of like a four-step dance. First, they ask people what they're supposed to do. Second, they literally watch them do it. Third, they look for the proof, like a signature on an invoice. And finally, they might even do it themselves, re-perform the control, just to make sure it was done right in the first place.
Now, this quote right here is so important. Just because errors have not been made does not mean that controls have worked effectively. Let that sink in. Maybe nothing went wrong that month simply because the employee got lucky. A real test isn't about the final outcome. It's about the process. Did someone actually check the work? That's the only question that really matters to an auditor.
Okay, so what happens when an auditor does find a problem? Well, that brings us to our final section, reporting the weak links. And it's really important to remember, this isn't about pointing fingers. It's about finding ways to make the whole system stronger for the future.
So what exactly counts as a deficiency? We're not talking about a minor slip-up. A deficiency is a fundamental flaw. It means either a control is missing entirely, or the one that's there is so badly designed or operated that it's basically useless at stopping or catching big errors in time. This slide is perfect because it shows the massive difference between a useless recommendation and a truly valuable one. The poor answer just states the obvious. Hey, you should number your orders. Thanks, Captain Obvious. But a good answer does two crucial things. First, it explains the consequences. Why does this matter? Well, it could lead to unfulfilled orders, unhappy customers, and lost money. Second, it gives a specific, actionable solution. Not just number the orders, but do a regular sequence check and investigate any gaps. That's how an auditor adds real value.
And that really brings us to our final thought. We've spent all this time talking about huge corporations, but these principles, they're universal. Every system, even the personal routines we have, has hidden risks and limits. So the question I want to leave you with is this. What are the hidden risks, the potential control deficiencies, in the processes that you rely on every single day?